The US debt ceiling is back again to spook markets, but it comes at a time when the US is reeling from an inflation shock and the threat of recession. Make no mistake, this is a huge tail risk. So in this video, we'll look at what the debt ceiling is, what would happen if the US defaults, but also some potential workarounds. This video is sponsored by Trading 212, which is a commission-free UK investment platform. So let's look at the US debt ceiling in a bit more detail. Let's begin by what we mean by a debt ceiling. The purpose of the debt ceiling is that it's a self-imposed limit on how much debt the US government can issue. Now, there used to be a very impractical system where Congress had to agree every single bond by law. That would include the coupon of the bond, but also its maturity. The problem comes when there's a period where there has to be lots of issuance, and wars in particular tend to be very expensive. Look at what happened to the US outstanding debt during the Civil War. Notice also that at the time, the nominal debt limit was a sum of individual security limits. There wasn't an aggregate limit on US debt. That changed in 1917 when such a limit was imposed on all US federal debt. But there were also single issue limits at the time. Then this system became even more simple when we had the Second World War, when the government imposed a general limit on all US debt. Then it left it down to the Treasury to decide how much to issue for a particular coupon or maturity. Now at the time, the limit was absolutely tiny in comparison to today. It was only $45 billion. Of course, today, it's well over $31 trillion. And the debt limit is increased regularly. It has to be because government outstanding debt increases over time. In fact, I made the last video about the debt ceiling about 2 years ago. But since 1960, Congress has increased the debt limit 78 times, and it's split not quite evenly between the two parties. It's been raised 49 times under Republican presidents and 29 times under Democratic presidents. The problem comes when there's an impasse in government such that the debt ceiling isn't raised, because what happens then is that it can introduce the possibility that the US government will default on its debt. Now that hasn't really happened historically. There was a near miss in the 70s, but as we'll see, the consequences of such a default would be catastrophic. Now let's look at the timeline for the debt ceiling this time around. When the amount of debt issued touches the previously set limit, the US Treasury goes into what's called extraordinary measures. So here they're trying to cut back on spending in order to not have to issue new debt, because they're not allowed to until Congress approves it. Now that happened in January the 19th, and the Treasury estimates that those extraordinary measures will be exhausted around June. Although the timing is uncertain because we don't know what tax receipts we're going to get between now and June. After the extraordinary measures are exhausted, we then get a period when we could get government shutdowns, and this is to reduce costs again. Now this means that government employees may not be paid, or at least their paychecks are deferred until the debt ceiling is raised. But the really hard limit is called the X date. That's the point at which the US could potentially default. Now that date, the X date, is very uncertain, but that's the crunch point when things get incredibly painful. And here's the letter that Janet Yellen, US Treasury Secretary, wrote to Kevin McCarthy, who's the Speaker of the House of Representatives, telling him that the debt limit had been reached and that she thought June was the point at which extraordinary measures would be exhausted. How likely is a default? I'm slightly concerned that it's more likely this time around. And the reason is that there are certain people in US Congress who ideologically may do something which is economically damaging to the United States. You can see that reflected in this article in the FT about Wall Street warning of the riskiest US debt limit showdown since 2011. Now, when the House Speaker Kevin McCarthy was voted into office, it took 15 attempts to do that. And some people think that in order to get elected, he had to agree to play hardball with Democrats when it came to issues such as the debt ceiling. So if we really take it to the wire this time around, then there could always be an accident and the US could default, or it may be deliberate. Now, if the US did default, how bad would it be? Here's what US Treasury Secretary Janet Yellen said about it recently. Of course, it makes me nervous. It would be devastating. It's a catastrophe. Now, when someone like Yellen says that, remember she's been chair of the Federal Reserve as well as US Treasury Secretary, it means something. She reserves those words very carefully. The reason why it would be so catastrophic if the US did default is that US Treasuries are seen as the safest asset on Earth. And that's because they're backed by the biggest, safest economy on Earth. You could kind of think of it like Jenga blocks, where US Treasuries sit at the very base of the entire structure. Every asset that sits on top of that structure is going to be dependent on the Treasuries at the bottom. So if you pull the rug on the safest assets, then there'll be a massive, catastrophic repricing of all those other assets, such as real estate, stocks, and we're not just talking about US stocks, we're talking about global stocks here, and of course corporate bonds. There's a published analysis by Moody's which talks about the potential consequences. Firstly, US GDP would fall 4% peak to trough. Remember, US GDP is usually around 2%, so this would push us 2% into recession. A consequence of that would be that 6 million US jobs would be lost, and the unemployment rate would more than double to over 7%. And if we look at US stock prices, those would be cut in 1/3. Now that would destroy $12 trillion worth of US wealth, and that's just in the US market. And of course, we'd see rates spiking, not just in the US, but elsewhere. And that would affect interest rate sensitive parts of the US economy. Mortgage rates have already spiked, but they'd spike potentially much further. And consumer loans and corporate loans would become more expensive. And this would have a negative effect on growth because the cost of capital would increase. So you can see that Secretary Yellen's description of this as a catastrophe is, if anything, an understatement. Before we go on to talk about the debt ceiling in the US, let me show you Trading 212. This is what it looks like on a mobile phone, and a big part of it is the communities aspect. So you can discuss single stocks, you can discuss ETFs, which you can see here beside me. That's the kind of thing which I'd look at in particular. Another aspect of communities on Trading 212 is that you can copy other people's portfolios, or pies as they're called. So here you can see the categories of pie. And one of the ones which I'd probably look at would be the one containing ETFs. So you can use ETFs to build a portfolio. Building a pie on Trading 212 is very easy. We simply choose which assets we want to go into the pie. In this case, we're going to choose global equities, global bonds, and gold in the ratio 80%, 10%, 10%. And then we're going to choose how to fund the portfolio. Do we auto invest regularly, or do we manually invest? That's what we're going to choose this time. And then we simply name the portfolio and we're done. Then we can simply rebalance the portfolio with a single click if we ever need to. Now, as a viewer of PensionCraft, you get a special offer from Trading 212 where you can claim a stock worth up to £100. In order to access that, simply create your account, verify it, and then deposit a minimum amount of £1. And then finally use the promo code, which is my name, RAMIN. Now, there have been close shaves with the US default in the past, such as in 2011 under President Barack Obama. And it literally went down to the wire. So it was just hours before the Treasury Department's deadline on August 2nd, 2011, when Congress finally approved the Budget Control Act. This created a two-stage increase in the debt ceiling. And at the time, it was just 16 trillion. This time around, it has to be well over twice that. But the consequences were long-lasting for the US in terms of its credibility. In fact, S&P downgraded US debt from AAA plus, the highest quality, down to AAA. But the consequences for asset prices all across the world were huge. And what's interesting is that this red line marks when the debt ceiling was actually raised. That's when things really kicked off. You can tell that almost all risky assets fell, such as emerging market equity, energy, you can see here with the USO Energy Fund, the S&P, emerging market local currency debt, the NASDAQ, high-yield US corporate bonds, and emerging market hard currency debt. So if you are thinking about how to hedge against this, last time around, ironically, long-duration US Treasuries were actually the best hedge. Gold was also a good hedge, as were investment-grade corporate bonds and also short-duration US Treasuries. And if we look at the yield on US Treasuries going into the point at which extraordinary measures were exhausted, you could have left the hedge until the very last minute. And that's because the asset impact and the impact on US Treasury yields was very much a last-minute thing. People simply assumed everything would be okay. And probably this time around as well, people will assume that everything's fine. We certainly haven't seen equity markets sell off. In fact, we've seen the opposite, which is a rally in early 2023. Another worry I have is that I think the stakes are bigger this time around. So if you look at the amount of US debt which is now outstanding compared to 2011, it's well over 30 trillion, whereas in 2011 it was around 15 trillion. So the magnitude of outstanding debt is much bigger. And if we look at the debt to GDP ratio as well, currently we're over 120%, whereas in 2011 it was well below 100%. And again, if we compare the size of the Fed's balance sheet right now, it's absolutely colossal compared to where it was in 2011. Currently, the size of the balance sheet is not much less than $9 trillion. And notice that now we're in a period of quantitative tightening, as the Fed allows these bonds to roll off its balance sheet as they mature. Whereas in 2011, we were still seeing quantitative easing as something that was ongoing. Also, at the moment, we're seeing tightening of monetary policy all across the world simultaneously. So tighter fiscal policy at the same time as tighter monetary policy, at the same time as a US debt default, I think is a very toxic mixture. Short of Congress approving an increase in the debt ceiling, what are the workarounds? One that's commonly cited on social media because it seems quite funny is to mint $1 trillion coin. How would that work? Well, the US Treasury makes profits from any difference between the cost of manufacturing coins, say, and the face value of those coins. It's called seigniorage. And there's a loophole in US law which says that for platinum coins, you can have any face value you want. So what the Treasury could do is mint a tiny $1 trillion coin. It doesn't have to be huge. It just has to be made of platinum, and then deliver that to the Federal Reserve, and then receive $1 trillion minus the tiny cost of manufacturing the coin into its coffers. Now, I think this is very unlikely to be something the US government would consider. You can hear what Janet Yellen says about it here. Remember, she was also Fed chair in the past. She says that the Fed is not required to accept it. There's no requirement on the part of the Fed. It's up to them what to do. And she says that she simply doesn't believe that Jerome Powell, Fed chair, would accept $1 trillion platinum coin as a debt ceiling workaround. Another piece of financial engineering which some people have suggested is for the US to issue high-yield US treasuries. To see how that would work, let's say that a normal US 7-year treasury would be priced with a coupon of 3.5%. You just look it up on the yield curve, and if the current yield is 3.5%, that would be the fair coupon to set for the new issue. If that's the case, then the price of that bond would be $100 when it's issued. Instead of that, what you could do is artificially raise the size of the coupon to say something like 10%. Now, bond maths tells you that that bond would now be worth $113. So the additional $13 would flow into the coffers of the US Treasury. But what's critical here is that the debt limit is on the face value of outstanding debt, which is only 100. So this would circumvent the constraint on the outstanding debt while still generating more revenue for the US Treasury. However, this would immediately put the US on the map as a high-yield issuer, as if it was an emerging market country. It would also have an effect on outstanding bonds. Those, I suspect, would see their yields increase too, and their prices fall dramatically. And in the UK, we've learnt at our expense what it means to have such a moron premium, as it's called. I just don't think this solution would ever work. Another suggestion is that the US government prioritizes who it pays out so that some people still get paid, particularly the bondholders. Now that means that some of the people who the government should pay will not get paid. So it's simply a question of who gets prioritized. And as Mark Zandi, who's a chief economist at Moody's, points out, that's going to be a difficult scenario. So he says, how will these lawmakers explain that an investor from China, who owns a lot of US debt, remember, should get paid before a senior waiting for a social security check, the US military, or the electric company? Of course they can't. And bond investors knowing this will still bail, and chaos would ensue. The fact is that people would still probably see this as a default. Another possibility is that the US invokes the 14th Amendment. Here you can see that rule. Now, this was just an amendment which was created at the time of the Civil War so that the North wouldn't have to honour the debt of the South. That's why there's this strange wording about suppressing insurrection. But essentially, the law says that the validity of the public debt of the United States shall not be questioned. In other words, the president would go ahead, issue more bonds, and cite this amendment as the justification for it. But I think this could trigger a huge constitutional crisis and legal issues which may not fly well, which would not look good on the global stage. But if I had to choose any of these strategies, I think this is probably the most likely to be invoked. Now, I don't think any of those workarounds is very credible, so let's just hope that Congress comes round to its senses and honours its existing obligations, because if it doesn't, the consequences could be utterly catastrophic. Now, don't forget our offer. You can get access to a share worth up to £100. And to do that, just use my name, which is Ramin, Ramin, as the promo code, or look in the description as to how to make use of that offer. And as always, thank you for listening.